Thank you so much, whoso reminded. And the purpose is not to argue and settle any scores, get into very volatile debates like it happens in the TV with Arnab Goswami and all. You are entitled to your view. The speaker will give obviously his view, and he'll present his view. Just by way of introduction, and I know Rajwade's and company and Mr. Desai for the last about 24 years now. And as you know, they were the only consultants, maybe with McCloy, and McCloy is McCloy at that point of time in 90s when India was yet to open up its market and all. Probably they would have trained almost everybody, every bank treasury man dealing with forex in those days. And in fact, it incidentally included the RBI governor, Mr. Venkataramanan, also, who I think had to learn his first lessons in forex after he became the governor from Mr. Rajwade, I think. And his book, Forex Management, Foreign Exchange Management, was the forerunner in those days. And that book, along with State Bank of India's internal training manual, were the only books available on that subject those days. And an authority, a very, very moderate moderator in his views. And I think his columns appeared for 25 years, weekly columns, 25 years continuously, I think, in Business Standard. And after that, he switched to Mint. And I have known Mr. Desai for the equal amount of time. They are the ones who trained me actually in forex, and rightfully, or correctly, they imbibe the right values regarding forex to me, rather than make me a trader who sees every 10 rupees and want to realize it. They strongly implanted in me. It's a risk management mechanism. You'll have to look at it that way. And it's so much so that despite having so many opportunities in the last 24, 25 years I've been handling this subject, I have just felt tempted only twice to cancel my positions and run contrary to what the risk management philosophy will say. And the one was the dot-com bubble, and one was the 2013 Indian meltdown, so to say, when India was going for a toss. And I was busy selling dollars when uh, rather contrary position to RBI those days, when under Mr. Raghuram Rajan, and made a neat pile for that time when RBI was selling something like $25 billion or something at 4% extra in the Dubai and the overseas markets. So that's the kind of disciplined approach they have, and I like them and respect for them for it. And even today we consult them, and must be having at least some hundreds of exporters and importers in his client list. So Desai, you can take your time, 40-45 minutes or something, for your opening remarks, covering the various economies, how they're going to tumble or skyrocket or whatever, plus of course what's going to happen in the Ukraine aftermath. And after that, they'll leave about 15 minutes for question answers. And I don't know why you got muted, unless you're muted. You can unmute yourself and speak now.
Right. So I guess all of you can hear me, and I'm unmuted. So good evening to all of you. I would, before kind of going into any kind of a talk on the international foreign exchange movements and the rupee dollar exchange rate, I would like to start with a story from Greek mythology, which is one of my favorites in relation to risk management, so that all of us have a perspective in the light of which I'm making the rest of my comments. The story in Greek mythology goes like this, that Lord Zeus, who was the sort of Lord of Lords in the Greek mythology, Lord Zeus would always say that Socrates is the wisest of all Athenians. And the Socratic line of philosophy is to ask questions. Socrates never provided any answers. When you read his dialogues with Plato, you will find that Plato gives answers to questions. Socrates asks a question, and Plato's answer runs into 3-4 pages, followed by another question from Socrates and another reply, which again runs into 3-4 pages, and so on it goes. So Socrates never provided any answers. He only asked questions. And Lord Zeus would always say that Socrates is the wisest of all the Athenians. And finally, one of the Greeks mustered up the courage to go up to the Lord and ask him that, why do you always say that Socrates is the wisest of all Athenians? And the Lord's answer was very illustrative for anybody dealing in financial markets. And he said that Socrates is the wisest because he's the only one who knows that he knows not. That is why he asks questions. He does not provide answers because he does not know anything in terms of the future. And I think when one looks at markets, it's very important to understand that we don't know what is going to happen in the markets tomorrow, and that tomorrow may be the next day, the next week, the next month, and certainly not the next year. Even the Reserve Bank of India governor does not know what the rupee dollar exchange rate is going to be even on 30th of April. And for lesser mortals like you and me to think that we know what is going to happen tomorrow, I think should be taken with a very, very large pinch of salt. Now, with that disclaimer in place, that I don't know what is going to happen, I would like to try and guess so the course of sort of where the markets are likely to be in the short and perhaps even in the medium term. And I'll start with the domestic economy first, because I think what happens in the domestic market, firstly, is of greater concern to everybody. And also because once we get into discussions relating to international markets, then it's going to be a lot more complex, a lot more extended in that sense. The domestic market is perhaps a little more easier to predict because we have the big daddy in the form of Reserve Bank of India in the market, even today controlling pretty much what is happening in relation to the rupee dollar exchange rate. In fact, although we have now had close to 30 years of a market determined exchange rate, we started in March of 1993. So we're close to completing 3 decades of a market determined exchange rate. But Reserve Bank of India's attitude to the exchange rate reminds me of a poster that I used to see in my college days. The poster had a cat sitting on a throne, and the poster read that you are entitled to your opinion as long as you agree with mine. And Reserve Bank of India's attitude to the market determined exchange rate is also identical, that the market can decide what the exchange rate is, provided we agree with what the market is doing. Otherwise, they are happy to intervene. Sometimes it is verbal intervention that we don't like where the rate is. It's maybe too strong, maybe too weak, or it could be change in interest rates, or it could be a change in exchange control regulations, or it could, of course, finally also be direct purchase and sale of dollars in the market, something that they have been doing fairly aggressively over the last 3-4 weeks, clearly indicating that they are not really comfortable with an exchange rate above even 76.50 per dollar, much less something like 77 and 78 and those sort of numbers. Just to illustrate the point, Reserve Bank of India in that week in which the rupee went close to 77 rupees per dollar. In fact, in the Singapore non-deliverable forwards market, it had moved to 77.40 in the morning before the interbank market opened, and then the Reserve Bank of India came in and controlled the rate, not allowing it to cross beyond 77. In fact, the intraday high was at 76.97 in the interbank market. And in that week, reserves fell by a good $10 billion, indicating a fairly strong dose of physical intervention by Reserve Bank.
WhatsApp पे आपके
More recently, the reserves have again shown a fall by roughly about $12 billion. So what we have seen over the last 3-4 weeks is the Reserve Bank of India's foreign exchange reserves going down by close to $30 billion compared to the peak of $646 billion, which was seen in early March. We are now closer to $606 billion. No doubt a part of this fall would be the result of the valuation changes in the non-dollar assets held by the Reserve Bank of India. Close to about 20-25% of the assets would be held in non-dollar currencies like the euro, the yen, the pound, and other currencies. And to the extent the dollar has gained in against all these currencies in the markets abroad, the dollar value of those non-dollar assets would have fallen. So part of this fall is also explained by valuation changes. But the bulk of the fall, there's no question, would be in relation to direct sales of dollars by the Reserve Bank of India in the market. I think here important to also understand what the Reserve Bank of India's basic philosophy in relation to the rupee dollar exchange rate has been over the last 30 years. After all, the rate has moved from something close to 31, 37 when the market determined exchange rate started in 1993 to today, roughly about 76 rupees per dollar. And that represents a fair degree of depreciation of the rupee across the last 3 decades. But if you look at it in what is known as real, that is inflation adjusted and effective, that is trade weighted terms, then you will find that whatever the Reserve Bank of India has done is essentially adjusted the rupee dollar exchange rate to the higher inflation in India compared to our major trading partners. So almost the entire depreciation that has been permitted by the Reserve Bank of India has been on account of the higher inflation in India to compensate both the exporters in terms of the higher input costs and their competitiveness in the international markets, as well as domestic industry competing with imports. Because after all, when input costs go up, domestic industry's ability to compete with imports also goes down, and the need for compensation by way of an exchange rate change becomes important. And that's pretty much what the Reserve Bank of India has been doing and will continue to do that in the days to come. And to determine the extent to which this is going to happen, one obviously needs to therefore look at the kind of relative inflation rates that we have in India compared to the rest of the world, or certainly our major trading partners. So our consumer price index-based inflation rate is at 6.1% for February. Compare that with 5.9% in the Eurozone, 6.2% in UK, and 7.9% in the United States. So by and large, our inflation rate is either pretty close to or actually better than our major trading partners at this point in time. And that is the main reason why the Reserve Bank of India has been intervening fairly aggressively in the market. The other, of course, is also to try and keep the impact of the higher international commodity prices a little bit subdued in the domestic market, principally petrol and diesel. The crude oil prices have already jumped by about 40-50%, even compared to recent prices as compared to early January. And if the rupee were to depreciate that much more, it of course increases inflation rate. Keeping the rupee strong in order to prevent domestic prices from going up is a little bit, well, like the tail wagging the dog. Beyond a point, it does not help. In the short run, it may work, but beyond a point, it's not going to help. At this point in time, it is from a policy perspective, perhaps even desirable, given, like I mentioned earlier, the fact that our inflation rate is somewhat better than the inflation in our major trading partners. There is no real macroeconomic case for depreciating the rupee. And to that extent, perhaps the Reserve Bank of India's action is not just unsurprising, but also fairly warranted. as that inflation picture changes, and I'll look at that in some greater detail a little bit subsequently, but I do expect that in the second half of 2022, the inflation rate in the major economies will start coming down as the interest rate increases bite into their economies. Their inflation is likely to come down. The Reserve Bank of India's policy remains accommodative. Even the latest monetary policy stance remains accommodative, indicating that they are circumspect about allowing sharp interest rate increases in India, perhaps aligning with the government view that at this point in time, increasing interest rates is not going to really matter to the economy in terms of controlling inflation. Most of it is imported from higher international commodity prices, and nothing that India will do will help. I'm a bit of a skeptic as far as that view is concerned, but be that as it may, that is what the Reserve Bank of India also seems to be indicating, that they are even today much more worried about growth rather than inflation. As we move into the second half of 2022, it is very likely that our inflation rate will stay in that 5 to 6% or even 6 to 6.5% band, while inflation abroad will start coming down. Part of it would also be because of the base effect, but part of it will also be because of that increase in interest rates that is very likely to happen. And as our inflation starts going up as compared to the major trading partners, you can start expecting the rupee to be allowed to be depreciated in the subsequent part, like I said, in the second half of the calendar year, if not the calendar year, certainly the fiscal year. So the October to December quarter and the January to March quarter likely to see some degree of rupee depreciation. And I would expect that by March 2023, we'll be closer to 77, 77.25 per dollar compared to the 75, 50, 76 or thereabouts where we are right now. So a degree of stability, perhaps a little bit of even strength in the short run, but some depreciation of the dollar, some depreciation of the rupee, sorry, vis-a-vis the dollar is very likely to take place. This is also from a macroeconomic perspective going to be driven by the fact that our current account deficit is likely to move up in the current year as compared to even the last year. Last year itself, we saw a fairly sharp swing from a current account surplus of $33 billion in 2020. And I'm talking now of the calendar year 2020. We saw an overall current account surplus of $33 billion, which swung to a calendar year 2021 deficit of $35 billion. And this is, in my view, likely to be further accelerated towards a $65 to $70 billion deficit in the current year. I have, of course, seen some market reports which talk about a triple-digit current account deficit in the current fiscal year 22-23. But I am not quite in sync with that, mainly because a lot of these projections take into account only the impact of the rise in sort of commodity prices, especially crude oil, on the import side of the equation. Very often it is forgotten that when oil prices increase in particular, they not only increase our imports of crude oil, but they also increase the exports of petroleum products. And the exports of petroleum products today are roughly about a third of our imports of crude oil. So if crude oil imports are going to go up by about $35-40 billion, we can also expect a $12 to $13 billion increase in the exports of petroleum products. That apart, we have seen very often in the past that when crude oil price increases are sustained in the international markets, then the Gulf countries start spending a lot more on their own infrastructure development, which in turn draws Indian labor to the Gulf area. And this results in an increase in remittances from Indians working abroad. So the increase in crude oil prices is to some extent offset by an increase in exports of petroleum products, and to some extent also offset by an increase in remittances from Indians working abroad. Of course, Overall, $70 per barrel for us is much better than $100 per barrel. But to presume that that entire increase in crude oil imports is therefore going to result in an increase in the current account deficit is something that it may not really turn out to be true. Also, there is another development that we need to bear in mind, which is that our net software services exports continue to show a very strong growth. We have seen them rise in 2021 by about 20% as compared to 2020, and sort of the numbers for January so far indicate that this trend is likely to be sustained. Even if it is not 20% and it rises by only 10-15%, that is going to contribute another 10 to 15 billion dollars additional sort of support to the current account. And overall, therefore, while a 65-70 billion dollar current account deficit likely, if the oil prices stay at about $100 per barrel, to expect that it is going to jump towards $100 billion is, I think, a little bit of a airy-fairy number. Even if you take that argument of $100 billion current account deficit, I don't think it's going to be that difficult to be financed, because roughly about $40 billion should come in by way of a sort of capital account inflows, while some of them have started taking their money out in relation to especially foreign portfolio investments. I think, again, what I'm seeing in a lot of domestic industry sort of structures at this point in time, a lot of the medium-sized companies going in for mergers and acquisitions, by and large, there's a growing belief that we need to become larger in order to be able to sustain ourselves in business. And I am seeing, even amongst my own clients, a lot of M&A activity in terms of mergers and acquisitions. Some of these mergers are getting financed by the FIIs, who may be pulling out money from the secondary market, but pulling that back into these kind of M&A deals. So net flows, I would not be surprised in terms of the capital account flows, which have dropped quite sharply between 2020 and 2021. Even last year, we saw about $35 billion of capital inflows on account of FDI plus FII. And I would expect that 35 to 40 billion dollars of inflows in the current year is not something that is unlikely. And if then you are left with a gap of only about 40 billion dollars to finance, then that's something that can easily come out of our reserves. On that question of reserves, we should also bear in mind that according to the data released by Reserve Bank of India, the latest data is available as on 31st January. Reserve Bank of India, apart from its foreign exchange reserves, also has outstanding forward contracts for purchase of dollars to the extent of $49 billion. So that's an additional armory that they have in order to be able to sell dollars in the market. Overall, I think the market is going to continue to be completely dominated by what the Reserve Bank of India does from time to time. And Reserve Bank of India's policy in relation to the exchange rate is going to remain trying to compensate for inflation rate differentials, which, to remind you, are at this point of time non-existent and likely to become once again a sort of feature of the market, requiring the rupee to depreciate over the next year or so. And therefore, my view that in the short run, we might see the rate move towards even 75 rupees per dollar. But over the year as a whole, I would expect the rate to move towards 77, 77.25 by March 2023. Of course, a lot of this could get overtaken by international events, as we have seen recently, the war in Ukraine, the sort of Russian attack has led to energy prices soaring. It could create problems in a whole host of commodities going forward. Potash is one commodity that I've been hearing from my clients, seeing an escalation in prices. Minerals are some of the others, some of the metals, some of the food prices, especially items like wheat, could see a big jump in the sort of commodities going forward. And that inevitably is going to have some impact in terms of A, our balance of payments, but more importantly, in terms of B, which is the inflation rate domestically. So what happens in Russia, especially in terms of what course the war takes vis-a-vis Ukraine, is something that could have further impact on international commodity prices in the months ahead. And that's something that obviously we need to keep an eye out for. Right now, the markets seem to be in a calmer state on the assumption that the Russians are at this point in time regrouping. Nobody really knows what the sort of objective of Mr. Putin, what his end game in Russia is. Is he going to be satisfied taking over the Donbass or the eastern part of Ukraine? Is he looking to sort of take over the entire country? Is he looking to sort of set up a puppet government over there? Will he expand his sort of ambitions to other erstwhile parts of the USSR? That's, as they say, we can only wait and watch and see what course it takes. In the meantime, there is the economic impact on Russia itself that one needs to bear in mind, and one will have to see whether the sort of Russian economy is able to sustain the kind of war efforts that Mr. Putin may want it to undertake in the months to come. Of course, I do believe that there's not too much bite in the sanctions per se, whether it is some of the banks who have been restricted from using the SWIFT mechanism. Ultimately, unless all Russian banks are included, I don't think it really helps too much. Even the announcement by US and UK that they will stop buying crude oil from Russia is pretty much meaningless, because the total Russian exports to US and UK of crude oil are barely 3%. Their major exports are to China, which is about 33%, and Europe, which is close to 40%. And that is what matters much more. And obviously, it is not going to be easy for those sales. In case of China, of course, they might even increase. But in case of Europe, it's not going to be easy to kind of bring those sales down. So realistically, what will hit the Russian economy hard is actually the withdrawal of businesses, especially the American multinationals, but even some of the European multinationals from US. So whether it is McDonald's and Starbucks, or it is Visa and MasterCard, or it is Unilever and Nestle, all of them are sort of shutting shop in Russia, or sharply reducing their sort of business over there. And to give you just a flavor of the problem, McDonald's alone employs close to 62,000 workers in Russia. And while the workers were paid their salaries for March, they have not been promised anything similar for April. And that is bound to start hitting at the demand in the Russian economy and start impacting on Russia in the days to come. Recently, the US Treasury has announced that they will not allow Russian government accounts to be used for payment of debt obligations, and a Russian debt default now looks pretty much around the corner. Of course, Russia has so far refused to remove the sovereign sort of their sovereign default clause from the debt agreements, and obviously they're not going to do it. But it does create problems for the country in terms of its ability to raise debt, and adds to the overall sort of economic difficulties for the country. So whether the collapse of their economy is going to outrun their ability to continue with the military campaign vis-a-vis Ukraine is something that, again, we'll have to wait and see. But that's certainly an element of uncertainty that is brought into commodity prices, and therefore into the inflation rate in India. But while everybody is keeping a close watch on Russia, what seems to be forgotten is that there is another international event that could overtake the world economy in the months to come, and that is what is happening in China. China has been the engine of growth over the last certainly a decade, if not longer, for the rest of the world. And China has been on a slowdown path, which has been fairly rapid. It started in the middle of 2021. The third quarter GDP growth rate came in at 4.9%, followed by a 4% growth rate in the fourth quarter, which some economists are skeptical about, but those are the official numbers, and I'll stick with those. And there was an expectation that in the first quarter of 2022, there would be a revival, but that seems extremely unlikely at this point in time. If you look at some of the numbers that are coming out from China, their property sales, which have been at the heart of the problem, even in January, February, commercial property sales were down 19%, residential property sales were down 22%, industrial capacity utilization, even in December, before the Omicron problems for China, was at 77%, which was a decadal low. The cement production is down by more than 26% in December. The steel production down again by double-digit numbers. GDP, therefore, unlikely to grow at anything like even the 4.5% growth rate that we saw in the second half of 2021, in at least the first half of 2022, which obviously then calls into question what is going to be the impact of all this on the rest of the world. And while I was talking to you about commodity prices in terms of restrictions of supplies from Russia, the other side of that is going to be to what extent are commodity prices going to be hit by the demand compression that is likely to come from China. Here it is iron and steel, cement, some of the industrial metals commodities could start coming down instead of the constant upward movement that we have seen in the recent past, and some people seem to expect for 2022 also. Overall, therefore, the Chinese economy slowdown could also start impacting on the world GDP growth rate. And that is a cause for concern for India from two sort of angles. One is the fact that our exports tend to be more closely aligned with the world's GDP growth rate. And to the extent there is a slowdown in the rest of the world, then obviously we are going to see some slowdown in terms of our exports. And the other is that there could be the threat of some dumping of goods into India by China. We've seen in the past that steel in particular, in some cases mobile phone handsets have been seen some kind of dumping taking place in India by China, and that might come back to the fore, which obviously has negative implications for domestic industrial growth rate. Overall, that's another sort of international event to worry about. And then, of course, there is the third, which is that of the US Federal Reserve Board increasing interest rates. And what is now, in my view, a slightly bigger threat is the contraction that is going to take place in the Federal Reserve Board's balance sheet. The Federal Reserve Board started pumping money into the world economy, and they started it at the time of the pandemic. They, over the last couple of years, they seem to have added close to $4.6 trillion to the size of their balance sheet. And this obviously has to start shrinking. And the Federal Reserve Board officials are already calling it from a quantitative easing or a QE program to a quantitative tightening or a QT program. And you're going to hear more and more about QT in the months to come, and to what extent that will have an impact on the market, again, in terms of the growth rate. Even as inflation starts coming down in the world, in the rest of the world, certainly the major trading partners, you could see that quantitative tightening program further sort of reduce the prospects for the world GDP growth rate, which again has an impact in terms of the kind of export growth that one can expect in India in this, particularly once again in the second half of the year. So while the first half of 22-23 might be a little bit more benign, it's the second half that might have a lot more volatility in terms of the kind of growth rate that one could see in the economy, and therefore the kind of impact that would have in terms of the financial markets in India, the stock market in particular, but also as a corollary, some impact in terms of the rupee dollar exchange rate. There is one event in the second quarter of 22-23, that is the July to September quarter, that could sort of bring in that depreciation of the rupee a little bit earlier, which is the potential for a Chinese aggression across the Himalayas. We should remember that June to September is the only period when any kind of battle or a war can take place between India and China across the Himalayas, because that's the only time that the weather conditions there are good enough for human beings to even fight a war or even settle over there. And we have seen in the past that these are the months when we see some kind of a military aggression that the Chinese sort of have towards India. Some of this could get determined by the course of the Ukraine-Russia war. If Russia is seen to have succeeded in terms of its short-term, at least, objectives in Ukraine, it might embolden China also to follow suit in terms of some of its neighbors. And out of the three countries that they have sort of issues with, that is Taiwan, South Korea, and India, we remain the softest target, partly because even in the past we have seen that the US is not going to sort of stand up and say that okay, this is something that we are not willing to tolerate. They're not even willing to bring in some kind of a Security Council resolution, despite the fact that it would obviously fail, but not even register a minimal protest of that kind whenever there is any kind of military aggression that China has towards India. And from that perspective, it is possible that we could see some kind of a sort of conflagration between the two countries, and that might be enough to rattle the financial markets in India and push the rupee towards 76, 76.50 again, like I mentioned, in that quarter of July to September. Barring that potential event, I would not expect anything to rattle the financial markets in India, at least over the next 5 to 6 months. Right, that's what overall I wanted to cover in terms of what I expect to happen in the financial markets, and I'll be happy to take any questions.
Thank you, Mr. Desai. That was a very lucid as well as a very reasoned out, reading of the situation. What I would suggest is people who want to put a question, you can put it in the chat box or put the hands signal in the reactions button. I'll know which order of priority to go by. Question answers, I take it as a separate recording. That's why my first question is, the people are saying that the US dollar will presumably lose its status as a premier trading currency, reserve currency, and people will start shifting to the other currencies. So what is your take on that?
Right. So I think if at all it is to happen, it's going to be a very, very long process. And it's certainly not going to be the Chinese yuan or what I saw, even more ridiculous, sort of one of those famous WhatsApp messages where they said that the Russian ruble is the one which is going to attack the US dollar, or some such completely nonsensical statement. But even the Chinese yuan, after all, it is the second largest economy in the world, likely to overtake the US, if not in the current decade, very likely in the next one. But I think if at all there is a candidate that could replace the dollar, conceivably it would be the euro. In sort of one perspective to bear in mind is that the UK economy became smaller compared to the US economy in 1905, 1906. And it took the US dollar another sort of 35 years in 1939, 1940, at the start of the World War that we saw the US dollar replace the pound's hegemony in terms of the commodities and financial markets. So I would not think that this is something that can happen in my lifetime. But if there are any younger members of the audience, they might see it conceivably. If at all it is to happen, like I said, it would be the euro. Certainly not the Chinese yuan. You need the currency to have much greater international acceptability. And that's something that right now, even the People's Bank of China is not ready for sort of the kind of capital account convertibility of the currency that would be required for anything like that to happen. So the short answer to your question is no.
Yes.
I don't think it's going to happen.
And Mr. Ravishankar Rao?
Yes.
My question is, I am a long-term investor. I've been dealing in stocks on a long-term basis, which is 3, 5, 7 years, and I've been dealing since the early 2000s. Should I sell all my stocks and wait for the market to correct and then reinvest in good stocks, or should I sell partly and book some profit, mostly or not at all? What would your advice be? Because at 11:05, one channel will say buy, the same channel at 11:15 will say sell. So all advice, whether in the newspapers or on TV, actually, in my belief over 20 years, is that nobody has a clue. Everybody is playing teen patti. What's your view?
Well, I agree to the last bit of what you said, that ultimately it is a speculative market, and therefore I don't think one can sort of say that anybody can predict anything. That's what I mentioned right at the beginning. But sort of to answer your question, I think what I'm seeing is that in the post-pandemic world, in India at least, you are going to see a greater movement of businesses away from the SME sector and towards the larger companies. And to that extent, if at all you have large profits in companies which are sort of, the SME sector side of the businesses, then it might be a good idea to get out of those. I would stay with stocks which are in large companies, which are market leaders in their sectors. Even if there may be a medium-sized company, if it's a market leader, then certainly that would be something that is worth staying with. Overall, in terms of the Indian economy, I think it's almost certain that we are going to become a $3.1 trillion economy when the numbers for 21-22 are released by the government of India, which should happen sometime in July, August. It will become apparent that we are now the 5th largest economy in the world. It is also clear that whatever be your sort of views on the various factors influencing the economy, we are going to grow by 7 to 7.5%. Certainly the sharpest growth that one can expect to see in any large economy. 5th largest economy in the world, growing at the fastest pace. I cannot imagine that the foreign investments are going to stay away from that kind of a market. And therefore, if one is to look at the Sensex dominated companies, then I would expect the Sensex to move towards 65,000 by March 2023 on the back of better sort of profitabilities of the larger companies. SME, I'm very, very skeptical, unless, like I said, they are in a place where they are market leaders in their industries.
Okay. But in fact, friends, I forgot to mention that, Mr. Haresh Desai is a chartered accountant himself, and he has been managing practically the business for the last about 20-25 years. And they have a large flourishing consulting practice with lots of people, which also includes a weekly mailer plus retainership consultants. In any case, if any of you are interested, of course you can get in touch with them directly. And there is one Mr. Subbu from Reliance who says hi to you.
Yes, I saw that.
Okay. Then there is one question. Are you able to read the chat box?
Yes, I do.
There is one question from Lenovo Tab M8. You can perhaps answer that question. After that, I'll go to Nimesh Savla and then Sarat Panda.
So I think bilateral arrangements, I would agree, will sort of have a very limited use. The sort of, I don't know whether this is being asked in the context of people talking about the rupee ruble arrangements. Let's bear that in mind that in the 1990s, these arrangements were made primarily to help India out of our own balance of payments sort of crisis. And as soon as our balance of payments improved and our reserves became stronger, particularly after the Pokhran blast saw the Resurgent India bond and the India development bonds, and the balance of payment situation completely changed for India, we were quickly able to repay that amount to the Russians. So the recent announcement probably has to do with the fact that our oil payments, we are making some crude oil imports from Russia, but remember that ultimately we don't have enough exports for adjustment of those rubles to take place. And some of the pharmaceutical companies which are exporting to Russia might benefit out of these kind of arrangements. But otherwise, in general, bilateral arrangements don't really work. As far as I think there was, before we ask, go to questions from others, I just wanted to cover another question that has been there about CAPEX LC with a period of 1 year. Left the exposure open now. If you are already advised them that insofar as capex is concerned, it is better not to stay unhedged in a volatile environment. The only other suggestion that you might like to make is that the client should look to use some kind of an option contract based strategy, and that will limit at least the downside risk. And if they are not prepared to pay even that premium, then the only other strategy left is to have a stop loss level in place, that if the spot rate goes above, say, 77, somewhere you have to tell yourself that thus far and no further. And if they still don't want to listen to you, then as a consultant, I must tell you that I have learned that you may give the best advice, but the client may not be willing to take it. And one has to be a little bit philosophical about it and not worry beyond a point.
And now Mr. Nimesh Savla.
Thanks, Mr. Kumaraswamy, for moderating, and Harish, thanks for sending us the link. So I have a couple of observations first and a question. Short observation first and foremost, the quote that you gave, Socrates, etc. That was fantastic. But more surprisingly, hearing from you the Sensex predictions of 65,000, having known you for probably 50 plus years, it was very surprising. And probably a little contrary to your first quote, but nevertheless, that is of course just a joke, as you know. But my question was that you mentioned that the yuan probably is not going to be, if anything, it's going to be the euro dollar, which could be an alternative. But here, they are also talking about the crypto. Of course, that I know is not going to happen probably in the next decade or so. But that's certainly considered as an alternative, or at least people are talking about as an alternative to the US dollar. Your views?
I think for the crypto to become any kind of alternative, ultimately some acceptability within the official circles, like the central banks or the central governments, would be absolutely essential. And until that happens, I think it's going to stay on the fringes. Some of the larger investors in these cryptos are some of the rich, or you can say the high net worth individuals who have, one can say, a vested interest in promoting the idea that crypto will take over from the US dollar. But if I don't think that the euro is going to replace the dollar over the next 25 years, I don't think that the crypto is going to take over from the dollar in the next 100 years. I am highly skeptical about. Ultimately, it needs acceptability within the central bank, none of whom are willing to do that. And even this talk about some of the Russian payments getting settled in sort of crypto is all, well, at best, I can say.
Thanks. Oligarchs, that's the other word. Investors in crypto. Anyway, I'll leave it at that. Thanks for the answer.
Now, Mr. Sarat Panda.
Good evening, sir. My question is, when RBI will be intervening, which consideration will be predominant? One, to defend any particular level. To second, to defend to curtail volatility. Or third, to have a lesser impact on overall inflation due to elevated price of crude oil. Which one will be the predominant consideration for RBI while intervening?
So some of these are sort of interconnected as for example, the defense of the currency obviously does result in the curtailment of the inflation rate also, as well as the curtailment of the volatility. But if one is to talk about what would be the driving concern for Reserve Bank of India, it would be essentially to ensure that the rupee dollar exchange rate is at a level which reasonably compensates the exporter and the domestic industry competing with imports in relation to the inflation rate differential. So it's not that they are trying to control inflation through the exchange rate, but to the extent inflation has already happened, if the exchange rate has already compensated the exporters and the domestic industry competing with imports, then they are happy to defend the rate. And that's why there has been some pretty aggressive intervention that we have seen in the last 3-4 weeks. But if one is to give any kind of order of preference for the Reserve Bank of India, it would be exactly in the order in which you have asked the question. That is, their first priority is the defense of a particular level that they consider sort of beyond the desirable one, then the curtailment of volatility, and lastly, the control of inflation.
Sir, you talked about the relative basis. Do you mean the rear? RBI will be watching the real effective exchange rate, sir?
Yes, the real effective exchange rate, but I believe that it is not the CPI or the consumer price index based inflation rate that they watch. It is the wholesale price index based inflation rate that is looked at.
Okay.
Thank you, sir.
Mr. Ravishankar Rao, you have any residuary questions? Your hand is still up. Okay. There is
Sorry,
one.
say that again. Sorry, I missed that. Please say that again.
You have any question? Your hand is still up in this one. I was wondering.
No, I'm a little skeptical, Mr. Harish, that there are big players playing games. On a Friday, the market falls 800 points, saying the world is coming to an end, and on Monday it goes up 1100 points, saying everything is sunshine. So who really plays these games? I mean, it's not market forces. There is some real games going on by some big players. So those of us who are long-term investors have to keep a watchful eye and navigate like you navigate on the streets of Bangalore or Mumbai. I'm in Bangalore. So you have to be aggressively defensive or defensively aggressive and manage your affairs to not get caught in the crossfire of these big players. So how can an index fall by 1,000 points on Friday when everything seems to be coming to an end? And why does it go up 1,000 points on a Monday and the whole scene changes? It's very strange.
Sure. So if you are a long-term player, then you can follow. I remember this, I forget the name of the company, but there was this ad that used to go that said that fill it, shut it, and forget it. So if you are invested, stay invested. and stop looking at the market on a daily basis.
No, but unfortunately, I did that 4 years ago in 2017 with
Mm.
one of the large who made the tagline belongs to that company. They destroyed my capital. So I suspect everybody. So now I have decided that I will believe nobody. I will believe my own guts. I will do my own
Right.
research and face my own
Of
consequences.
course, that is always the best policy.
And before I go to Mr. Brij Nagpal,
Yeah.
in fact, many of the participants are first-time participants. I don't know whether you are already in the group. The recording will be available in my YouTube channel. You can search for Kumaraswamy Virupakshan. I have put it in the chat box. You copy it, and I'll try to upload it by tomorrow sometime, and you can access it. Now I go to Brij Nagpal. You had some question.
Yeah, I just wanted to have check any view on gold, Mr. Desai.
In general, if one is looking at gold as an investment, as distinct from a commodity, as an investment, my general view is that over the long term, take any 15-year period, for example, and a gold investment, certainly in rupee terms, makes no sense because it does not compensate you for the interest that you are giving up, even in relation to the bank fixed deposit. As far as a portfolio is concerned, there's no question that 5%, maximum 10%, you should be keeping in gold because that is ultimately the only inflation hedge that insulates you in a way completely. Second is, let's not forget that gold is ultimately the only convertible currency in the world. You go to any remotest part of the world and you can always convert your gold into the local currency. And in that sense, it is the only convertible commodity, one can call it, in the world. To that extent, a limited amount of gold is worth keeping. But in general, as an investment, it's a lousy investment. In that sense, I think women make better use of gold than men. At least they wear it. Men just buy the gold and put it in their safe deposit lockers, and it makes no sense to me at all.
Understood. Thank you very much.
Mr. Rajappa sends his compliments. Thanks for an insightful session. And Mr. Parameshwaran, good presentation. Thank you so much. Mr. VSP, should buy ruble now? Question mark.
Very volatile, very volatile. It's a high risk, high reward strategy. Just before the war started, the ruble was at about 74, 75. So there is scope for another 10% improvement in the ruble. But obviously, if at all you want to buy it, it'll have to be in the international market, not in the domestic market, where in India, ruble is not a convertible currency and therefore you can't really buy it. But if you are sitting somewhere abroad, or if you have access to the markets abroad, then there is a potential 10% gain from where we are, provided you believe that the war in Ukraine is coming to an end fairly quickly, and the ruble will therefore move back to where it was in the pre-war period.
Thank you so much. Any other comments? Otherwise, we will, many of the members are new. So what we do is, how we thank is all of you come on the screen and clap for this speaker. So may I request everybody to come on the screen, please? Please come on the screen. Please come on the screen, please. Thank you so much, Mr. Desai. It was a very enlightening piece of talk, very cogently thought out and delivered. Thank you all for attending the session. And you can access my YouTube channel, this presentation, the YouTube channel tomorrow. There is one Mr. Tushar Patel who has raised his hands now. Mr. Patel?
I believe he's just clapping.
Oh, okay. Okay then. Thank you all. Have a great weekend, whatever remains of it, and do join in the future sessions. Thank you so much. And
Thank
Thank you,
incidentally,
Kumar.
the
Thank you.
crypto session will be somewhere in mid-May, let's say May 15th or 14th. There will be a crypto session which is devoted exclusively to crypto and how it operates, what is the backbone architecture, as well as what is their reading going forward. Thank you so much.
you very much.
Thank you, Kumar.
Bye.